welcome to BloombergQuint. The Reserve Bank of India's new rules for private bank ownership and corporate structure came in on Friday. No large changes. Perhaps the biggest news was in what they didn't say, which was any sort of easing for allowing large business houses into the banking sector. Joining us to talk about some of the fine print of those new set of rules is Suresh Ganapathy of Macquarie. Suresh, thank you so much for taking the time to speak to us here on BloombergQuint.
Pleasure. Thanks, Leela.
Suresh, I'll start with the sort of the headline of what was not in the rules. I think the committee had, in a conditional fashion, said that perhaps one could allow for larger business houses to come into banking more easily. But even they had put riders because they had said if the Banking Regulation Act is amended, etc. The RBI seems to have kept that in abeyance. A correct decision given all that we've seen over the last few years.
Of course, I mean, if you look at really the only large four successful institutions who thrived when the licensing regime was opened up in 1994, it was IDBI, of course, which was taken, which was then reverse merged, then ICICI, the HDFC Bank, and of course Axis, right? So even IndusInd Bank and most of the others had their own share of issues where clearly the promoters spawned banks, and of course later on we saw what happened with Yes Bank. So clearly the experience for Reserve Bank of India has been pretty bad with respect to giving licenses to corporate houses, and I think that's the right move. And even today era, it's not that the RBI is saying corporate houses are banned explicitly. There is no rule in any regulatory framework of Reserve Bank of India which is banning corporate houses. They're just telling we have opened up the universal banking license on tap basis. Anybody wants to come, you come, and then we will take a call on a case by case basis. I think that's what is the approach that Reserve Bank of India will follow going ahead.
Suresh, the only sort of counter argument to easing up on corporate entry by perhaps saying easing up the rules of saying how much percentage of your business can be outside financial, etc., was that the banking sector needs capital right now. It was also that if the government embarks on a privatization program, a substantial privatization program, then who are the people who will come in and invest? So widen out the space for people to come into banking. That argument clearly didn't sort of change the RBI's mood at all on this.
Yeah, but then remember that there are various studies and research that have shown that the cost of large bank failures is far higher than taking a very myopic view and opening up the floodgates of banking license to the corporates, and so that you attract fresh capital. And say, for example, 10 years on the line, there is a massive round of bank failures. The contagion impact is so high, so significant that that can more than outdo the benefits which comes out of giving a bank license to the corporates. And then that is the approach that the Reserve Bank of India has taken at this point in time, that what is beneficial for the system in the longer run. And history has shown that very clearly. Giving licenses to corporate houses who have multiple interests and who have convoluted architectures with respect to their various business models and subsidiaries itself can open a Pandora's box for a lot of problems in future. So I think that's the cautious and guarded approach. We need to really look at that rather than saying that the banking system lacks capital. And there are various ways in which you can try to attract capital, right? So you can actually be a bit more progressive with respect to reforms in public sector banks so that there is more attraction of private capital. They're okay. I mean, sovereign wealth funds can own 10, 15, 20% on a selective basis. You don't necessarily need to give a license to a corporate house to ensure that the privatization agenda happens. So if there is a will, there is a way. Clearly, they can find out ways to privatize it in a better fashion without opening up the risks for the system. Right?
Fair enough. Suresh, what they have done is allowed promoters to hold 26% over the long term. In many ways, that's a stamp of the Kotak dispute on that decision. Plus, also the way they've defined equity. But it's a justified decision. There's real logic behind allowing 26%, right?
No, the logic is very clearly that a couple of years ago, the government changed the voting rights cap from 5% or 10%. I can't recollect. I think it was 5%. That they changed to, actually it was 15.
It was 15 to 26.
That's right. So it changed from 15 to 26%. So here there is a dichotomy, right? So clearly the government itself is saying that, look, I'm okay to have a voting rights cap at 26%. So they just nearly aligned that to the voting rights cap of 26%. And they're giving an equal level playing field to anybody else who has dipped below 26% to hold at 26%, and they're also very clearly telling a glide path for any promoter who owns more than 40-50% stake in the initial stages that eventually, look, I'll be allowing you to hold 26%, which is in line with the government statute of having 26% voting rights. So it's all fits the piece of the puzzle well in sense that there is a proper alignment across the board, and I think that's what they have done, and that's the right thing to do in my opinion. I mean, holding a 26% stake is still okay because of course the majority stake is with the non-promoter promoters who can obviously call the shots. So I think it's a step in the right direction. But having said that, Ira, I still believe that it is not automatic, in the sense that it's not necessarily that anybody who has 15% or 10% will go to 26% automatically. They will have to, of course, take the blessings from the Reserve Bank of India, whatever governance structures that they will have to take care of it to reach 26%.
So there are two potential beneficiaries, or two kinds of beneficiaries from this. One, people who may, promoters who may have fallen below 26 and who can or have the ability to put in more capital and go up to 26. And then the other slightly newer banks where the promoters needed to come back to 26%, but to 15% earlier, but now can stop at 26%.
That's right. So these are the two biggest beneficiaries coming out of this rule. I think the bigger benefit, there are not very many banks who actually where the promoters own less than 26% stake. I think I can only recollect of IndusInd Bank, but then there will be a lot of these guys and the future prospective licensees who would be, of course, 5 years, they will be having 40% stake, but at least they know they have a skin in the game and they will eventually be allowed to hold 26% stake. I think it's more for the second or the latter issue that you pointed out rather than for the first case, because I think in the first case, only IIB, if I can recollect, fits into the bill.
The others is like Bandhan, and plus some of the small finance banks may benefit as well, right?
Correct. Yeah, that's right. Yeah.
Actually, one of the sort of softer things that they have acknowledged this time around is really valuable, right? This whole divergence in rules across different licensing rules, they made it very clear that from here on, if there is a new set of rules for a new, class of licenses or something, they will get harmonized across all categories, right? I mean, that's good. That's because you don't want, like Kotak's case, for instance, different rules changing every 5 years. That's not fair to the promoters or the bank applicants.
Of course, that's right. So I think that should be the right approach going forward. For example, there was a lot of confusion with respect to the NOHC structure. So very clearly they are telling that, I want an NOHC structure if you have multiple subsidiaries, but if you don't have a multiple subsidiaries, it's okay, you can move towards a bank for an incremental licenses. Now, I don't know how does this rule harmonizing play for existing people who have an NOHC structure. So there, obviously, there is going to be some element of discrepancy at this point in time. But nevertheless, yes, I think harmonizing of rules is very clear, and at least you have one, the problem what happened was that, especially with respect to the licensing conditions, it kept on changing on an individual bank-to-bank basis. Like, for example, I can go on and on as to what happened when Kotak landed up getting a banking license, and eventually how the rules kept on changing, right? So they really don't want such a kind of issue to happen. So it's better to have a very uniform set of guidelines so that they don't differentiate between one promoter or the other promoter. Eventually, everybody in the system adheres to one common set of principles. At least the law of the land becomes very clear as to who is eligible and who has a skin in the game eventually, if this is where the regulations were to be kept in place. So yeah, it's a step in the right direction, I would say.
Just explain the NOHC issues in the current landscape. Who are the people who could potentially, collapse these structures? But there are tax issues, I believe, in collapsing the structure more than anything else.
See, all the banks today have a problem, right? So, for example, existing banks, they don't have an NOHC structure. And what RBI is saying is that incrementally, any guy who ends up getting a banking license, and in case he has multiple subsidiaries or multiple businesses, I don't want such a thing to be housed in the bank. I want an NOHC to be kept, under which there is going to be a bank, and then there is going to be an EMC or NBFC or any other kind of businesses. That's what they are very clearly telling with respect to incremental structure. So they're allowing collapsing to happen in case you have only banking business, right? So, for example, the likes of the small finance bank that we have in India, you are, of course, having a uniform alignment as per the Reserve Bank of India rules that they're saying you can collapse the structure. But what happens if you are under a current structure, which is not an NOHC structure? That's not very clear from the rule. Because today, for example, in ICICI and HDFC Limited, Kotak itself for that matter, none of them have an NOHC structure, right? The bank is the one which is owning everybody. So what exactly happens in that case? There is not much clarity coming from these regulations. They're only talking about incremental applicants. Existing guys, obviously, they are relatively pretty silent with respect to compulsorily forcing them to have an NOHC structure. I don't think that is likely to happen till there is parity with respect to tax rules at the various states level and stuff. So that is also one of the regulations which is there in one of the recommendations mentioned, that there has to be a tax parity. And that's why RBI has not touched upon that, because tax parity obviously really requires the government consent. So that's a gray area at this point in time, specifically with respect to existing structures.
Suresh, there was a smaller sort of recommendation, but perhaps important in the context of what happened at Yes Bank, which is monitoring of pledged shares of promoters. and that if your holding, your required holding is not being maintained after that pledge, the RBI will disallow it. Plus, you have to get RBI approval for every 5% transfer in voting rights. This is sort of learnings from the last few years, or is there more to it?
Yeah, of course. I think we have seen the problem with the pledge shares is that there is a lot of convoluted, structured financing which was happening, right? So not only with respect to Yes Bank as a structure, this is actually happening in some of the corporate entities also, and clearly many of the corporate entities went into a problem. And same is the case with Yes Bank and Yes Bank subsidiaries, where clearly a lot of pledge shares and diversion of financing which is happening, right? So this is very essential with respect to ensuring that the true stake of the promoter remains with the promoter without any, that is free of encumbrances, right? So at the end of the day, you know that the guy is not over leveraged, right? Because then there is commitment for the promoter with respect to bringing in capital. And I think definitely this is again a step in the right direction, because the fact here, Ira, is that if you're allowing the stake to go up from 15 to 26%, then that has to come with safeguards in place, right? So obviously, the promoter is trying to pledge more at a 26% stake, which he has, which is a larger amount of stake. And in case, of course, the bank is doing pretty well, then there has to be safeguards and risks in place. And this is again a step in the right direction, I would say, which will ensure that such kind of transactions which happened in the past doesn't happen, and there is a lot of safeguard put in place for the system as a whole.
Suresh, two questions on the new licenses side. The increase in the capital requirement for universal banks, setting up of new universal banks from 500 to 1,000 crore, that's quite steep. What do you make of that?
Absolutely not. You're talking
not
about
steep?
You're talking about 1,000 crores in an era where private equity and VC guys are willing to cut checks of billions of dollars every day, where the valuation goes up every week. So I think 1,000 crores is nothing, to be very honest. I mean, that is definitely not a steep requirement to get a banking license for anybody in the system. You tell me which small finance bank in India won't want a universal bank license, or you tell me which payments bank in India can't afford 1,000 crore. In Paytm, for example, hypothetically speaking, they just raised 8,500 crore rupees of cash. I mean, what are you talking 1,000 crores?
Okay. Fair enough. Fair enough. And the conversion rules for payment banks left at 5 years. I mean, I would assume that that's actually, that's the least they can do. There have been people who have argued that there shouldn't be a conversion window from payment banks to small finance banks at all.
Yeah, I mean, I'm very surprised that first, the good thing is they didn't go back to 3 years, because that would be a regressive step in my opinion. It's better to keep it at 5 years. So retained at 5 years, which is a step in the right direction. But the point here is that the fact that they gave the payment bank licenses is because of the fact that they didn't have the confidence about these banks' ability to lend. So I really don't know. 5 years of successful payment operations means you really think these guys have the ability to lend? I think here again, this is not going to be automatic at all, right? So what they're telling is, after 5 years of operation, you are eligible to apply for a banking license. So again, if you were to really look at it, if you look at the history of people who have got a small finance bank license, except EU Small Finance Bank, all the guys, when they got a banking license for microfinance players, right? So clearly the objective of giving a small finance bank license was to ensure that there is financial inclusion at a larger scale. And that was the goal. So for example, in XYZ fintech or a payment bank, or rather the fintech ecosystem which is doing consumer durable loans, what is exactly small finance about it? The ticket sizes could be small, but you're not necessarily doing something which is enhancing the productivity of the country, or doing something for the betterment of the people out there who are actually doing or working there. So I doubt whether this is going to be as simple as it is. For example, Bharat Pay, with landed up getting a small finance bank license, that was a very clear quid pro quo era, right? So they decided to bail out a completely beleaguered bank in PMC, where there were not many people who were willing to buy that. And of course, they had enough capital to come and do that. So on a very case-by-case selective basis, as long as there is some kind of a quid pro quo here, I really don't think getting a small finance bank license is also done deal, unless there is a strong case for one to establish that there is a lot of financial inclusion activity which is being carried out.
Like in the case of India Post, perhaps.
Of course, yeah, India Post, that's right. Look at all the small finance banks, MFI institutions for that matter, clearly. So those things really would matter before giving in. By definition, the tickets are 50-75% has to be priority sector lending, right? So let's hypothetically assume that any fintech which is doing a BNPL player None of the lending is priority sector lending, right? So if you want to have 75% priority sector lending, doing a consumer durable loan or doing a loan to buy a Nike shoe is not priority sector lending, right? So how exactly you need 75%? So the path should be very clear. No, none of these fintechs can get into microfinance lending. So how are you going to achieve 75% lending, right? So it can happen only through the merchant route. It just can't happen through the BNPL route. So if BNPL is where you are going to be, which most of the fintechs currently are in the BNPL space, a large amount of fintechs, and none of them will become eligible for a small finance bank license because they don't meet the 75% PSL requirement clearly. So you will have to meet the 75% through micro SME lending, which obviously is a different ball game altogether.
Last issue, Suresh, I saw in your note that you also interpreted the guidelines to suggest that there isn't a great mood right now to move towards these digital bank licenses, which I think Aayog has also pitched for. Why did you read that into these guidelines? I'm curious.
Well, first of all, it has taken 2 years for them to even think about it, whether to give corporates banking licenses, and then still at the end of 2 years, we still don't have clarity, right? So what makes us believe that they're going to go one step ahead and do a digital banking license? But Lata, I think the broader argument that I'm trying to bring towards is the concept of digital banking license is that in India, we obviously have this great, absolutely fantastic open stack program, right? So you can do an eKYC through an Aadhaar. You can, in fact, if you go to Brazil and do it, you check it, it takes 1 week or 2 weeks to open an account. It's not as simple as just giving an Aadhaar ID and opening up an account. So it has become so fantastically seamless through the eKYC, through the Aadhaar, through the UPI. Then you are possibly talking about the account aggregator framework, which is democratizing the entire data. Then you're talking about the open network, which is basically streamlining the entire or making open source the entire SME financing platform. Where in the world you have such kind of course your DigiLocker and everything, all these kind of things are completely open platforms. When you have these open platforms, why do you need a digital banking license? Anybody can do an eKYC, anybody can go and take an, of course, based on consumer consent, and also you have the data privacy bill, which talks about that, right? So I think a lot of these things are so open that we are pretty positive about the fact that, or what we are arguing here is when you can use some of these open architecture platforms and grow your business, why do you need a specifically digital banking license which can qualify you from lending or accept deposits? You can use some of these open architecture sources and do a pretty good job about running the business in a very effective way.
No, absolutely. I'm fully on board with that point. Suresh, I'll leave it at that. Thanks so much for taking the time to speak to us. Appreciate it.
Yeah, pleasure. Take care. Yeah.
Thanks for watching, Bloomberg.